Jigar Mistry is with us, co-founder of Buoyant Capital. Jigar, good to have you with us here. Thank you very much for your time. So before we get to quick views on the market, I mean, if you want to start with that, just preface your answer there. But what I really want to ask you is, what have you done lately, Jigar, in your portfolio? What have you added? Because flows are coming in.
Good afternoon, Prashant. Thank you as always for inviting us. See, I think we can keep talking about valuations and how sort of that is, looking a little bit off, earnings are not catching up. But we are doing the numbers as we are speaking. And if you look at the lows of COVID, then the total retail ownership of each and every company in India, if you take market cap times retail ownership, total that number up, that was at around 8 lakh crores, right? 8 trillion INR. If you look at the latest numbers, that's upwards of 60 lakh crores, right? So 60 trillion. So retailers, 14.8 crore demat account holders, have cumulatively generated a net wealth. Some of it might be inflows, preface it, but a net wealth of in excess of 50 lakh crores in under 4 years. Just to tell you how big that number is, the total household savings in India, including gold, real estate, everything, equity ownership, is 14 lakh crores a year. So net, you are essentially talking about retail having made so much wealth, and predominant of it is in small and micro cap space, that each and every opportunity is essentially an opportunity to buy and add more. We have had a seminal event in the decade, transpire last month with BJP not getting as many seats as market expected them to. And that was brushed aside, and we ended the month like 7% higher. So I think just because of the net sort of zeal and enthusiasm with which retail seems to be approaching this, it's just taking a few sections of the market really high. We are using this opportunity, sort of, I think we spoke last month as well, to sort of dial down the risk a little bit. We were almost 63% in small and mid caps by May 2023. Like everybody else, we have also had a phenomenal run, and we are taking this opportunity to bring it down closer to 50 odd percent. If the market continues to remain as giving, then we might sort of bring it down a little further, closer to 40% over the next few months.
And using that, so when you bring it down, allocating it to large caps, I'm assuming, right?
Yes, Prashant. So both things, businesses that we think have gotten fairly valued, we are taking this opportunity to get out of them and getting into businesses which are a lot more interesting. For us, pharmaceuticals is an interesting space. BFSI continues to remain an interesting space. Auto ancillaries is a space that we have been looking at it over the past few months or so.
Out of in the three areas, what have you added?
Added all of them, Prashant. And also, if I look at our 3 months numbers, we have added a little bit more on IT as well. But although I would want to believe that, given that, it's just a valuation re-rating story beyond the point, right? Earnings are unlikely to run up in a hurry, as prefaced by sort of the hiring slowdown that we are seeing. But yes, relatively speaking, those businesses were not all that expensive. So we have been adding all those and a little bit of IT as well.
Jigar, in the past, I remember you saying you like Cyient and eClerx. Those were the two mid-cap IT names that you used to like. Do you still hold them, or are there new names that have attracted you in IT?
Part of it, Rima, we do hold. Also, Allsec was another business. So Cyient, eClerx, and Allsec, yes. So those were the small cap IT names we used to own. I think we continue to own some bits of it, although not as much Cyient now, but eClerx and Allsec we do. But we also added a lot of large cap IT over the past 3 months, just relative to how the businesses were stacking up. So yes, to your question, we do own some part of those small cap businesses.
And in large cap IT, is it the larger ones like Infi, TCS, or the potential turnaround where, say, a Wipro or a Tech Mahindra, there has been a leadership change, the valuations are relatively less compared to Infi, TCS?
Historically, Rima, it's been HCL Tech and Infosys for us. So that's where we continue to, have exposure at the moment.
Okay, all right. Hi, Jigar. Good afternoon. Good to see you in. I think I've asked you enough about metals, right? Let's keep that one aside. Let's wait for November, when we see some more action or there, get that trade right and you're dancing away to the bank. Otherwise, it's a difficult one. So let's keep metals aside. I want to ask you about cement, because we have chatted a lot in our friendship, in our professional relationship as well with regard to cement. Now, there have been 3 big deals that have taken place in the last 6 to 8 months. Kesoram, we were on top of that. Penna. And then we had Ultratech going ahead and buying Mr. Damani's stake in India Cement. Who would have thought, right? All these 3 assets. I think in the last 10 years or so, we heard it repeatedly. Now there is talk that there is a couple of more assets getting folded up. What is your view? What's well placed? You have a couple of these names, Orient Cement, Sagar Cement. Valuation wise, yummy. That's always been the case. Orient Cement actually, even after the run up, still it's a little lower than replacement cost. How would you approach this theme?
Nigel, so sort of what we used to say is the worst place to be is a mid-sized cement company, right? Nobody would think of acquiring you, and you would think of acquiring other companies which the markets won't like given the amount of debt you would have to take up. So it's either great to be like a very large cement company and then you would want to gobble things up, or you would want to be an extremely small company with sort of inferior logistics and sort of yield to market and the logistics part not being all that great, and then you would want to sell out. I think if you chart out the EBITDA per ton of cement companies over the past 15 years since we have been talking, Nigel, I think that's hovered in and around that 1,000-1,200 rupee per EBITDA per ton numbers. And I think because companies kept on adding capacities instead of acquiring them, they created a situation which allowed, continuous growth in volumes, but no growth in profitability. So eventually, if the larger companies say enough is enough, let's acquire whatever can be acquired, and then we will go around, looking at taking price increases. Because eventually, even in telecom, right, that's what it happened. Once it decided to a situation that there are now only 3 players, and our aspiration is to reach the lower end of, say, Africa's ARPU range. Now we'll start taking price increases. So eventually, if all of these smaller capacities do get acquired, demand in the next 4 or 5 years rises to a level which starts making sense for them to take price increases, then we can look at going towards that 1,500, 1,700 per ton EBITDA. So I think the better place to be, because smaller companies would still be, acquisition premium if it's a binary trade, right? If they do get acquired, then these valuations are very attractive. If they don't get acquired, then even $100 is a lot more expensive. So the better place to be is certainly not mid cap, may not be all that small cap, but larger cap cement names is, I think, where we have reasonably decent exposure, Nigel.
Okay, fair enough. Jigar, coming back to the 3 areas, right? Pharma, what do you like? Auto anchs, what do you like? And I think you said the third one was financials?
Financials, yes, Prashant. So sort of the whole GFCF to GDP sort of rising trajectory that we keep discussing, there were areas which sort of we played at, right? So if that GFCF to GDP do end up increasing, then it all starts with OEs. So, you have sort of the big cements, ABBs, L&Ts of the world do very well in trade first. Then you take a step back and you come to EPCs. And there are EPCs, the working capital is something that you need to look at. And there are some plays which are still interesting there. Then you take a step back and you look at all the suppliables, right? The consumables like cement, cables, pipes, and so on. Then you take a step back and you look at all the, say, financiers of those trade, which is housing finance companies, which I think we have a lot of exposure in housing finance companies. And you take a step back and then you look at all the corporate banks. So SBI, Axis, Bank of the Lords, Kotak Mahindra Bank, even HDFC to some extent, and ICICI obviously. So I think this is the way in which I think the numbers have stacked up. We have exposures across the board here, other than OEs. OEs we think have gotten really ahead of themselves. And those valuations, you can jump in and say, okay, it doesn't change. But if you do a reverse DCF, it's difficult to justify valuations on many of them. But across the value chain, I think there is a lot of interest. On the second part, which you mentioned, which is automobiles, See, given the disruption that we are looking at, it's better to stay with a little more, the auto ancillary side of things rather than the OE side of things. So that's where we find our largest exposure. A lot of auto OEs are also getting diversified and getting into some amount of railway work because at the back end, they're able to cast and forge things along the way. So that's where we have reasonably good exposure. In the pharmaceuticals chain, I think the older names remain, but increasingly, there are a few niche plays that are coming up. In contrast media is where we have had a reasonably decent exposure on an incremental basis. So this is how sort of...
Jigar, which one?
Sorry. The contrast media. So there is this company called Indigene. Bluejet. Bluejet is an emerging company in the contrast media space. And Indigene is also an interesting space, but it's difficult to classify it, whether it's an IT company or a IT company in a pharma business. So you can split it either ways, but those two are the interesting names that we have come about to.
Okay, Bluejet and Indigene, right?
Yes, yes.
Got it. Next time we start, our next conversation will start with those names.
So Indigene is one of the recently listed companies, and which is why he said it's a mix between pharma and IT, because they provide digital marketing to pharmaceutical companies. So their clients are pharma companies, all the pharma companies, but they have a platform, a tech platform.
Yeah.
So which is why it's at the intersection. 539 is the current market price, and the price band or the issue price was 452. So the stock has done pretty well since its listing in May. So about 2 months to go.
But in a market like this, I would say it has not done so well.
25%,
which means there could be an opportunity, and I think that is why Jigar is.
Maybe.
I'm assuming that's why Jigar has gotten in. By the way, who tracks this then, Ekta or you?
Ekta.
Anything less than 20% in this week is not doing all that well. So.
All right, Jigar, great speaking with you, but we'll sort of dive into these names and more names next time. Appreciate you joining in, and it's always great speaking with you. I think what 10